What's up, traders? I'm the one with the dark side team here. And continuing where we left off on that previous video, as far as being right or trying to make money in the market, the difference between the two, and how to try to make sure you're more focused on actually making money than being right. And one of the ways that we can really work on this, and I'm sure again this applies to all strategies, any style of trading, smart money, Fibonacci, trend lines, supply and demand, whatever you do, there is a difference in trying to be right by using your strategy and trying to make money to also use your strategy, and that's what we're trying to dive into here. So, one of the main things that I think we should all be very aware of is that the market doesn't care. Okay, the market doesn't give a shit. All right. Sorry to say it that way, but it's the truth. And what I mean by that is, just because I'm here in Florida, I'm in the U.S. I trade New York session, right? Just because it's 8 a.m. Monday morning, New York open, and I've got my cup of coffee and I'm sitting at my desk and I'm ready to go and I'm ready to take a trade because it's Monday and it's my session and I have the time to do it. The market doesn't give a shit about that. Okay? If the market is not ready to give, then it's not ready to give. Okay? You cannot receive. Okay? What else? What you can do though is you can go out there and stare at the screen for long enough at price action that doesn't make sense, and you can figure out something to get yourself involved with. You can figure yourself out a low probability scenario where maybe you'll say this is a liquidity sweep and now you're going to sell, or maybe you'll say this is a break of structure to the upside and now you want to buy. You'll be able to find something there to do. And it's because, again, you're trying to be right. You're not trying to make money. You're trying to force a scenario just because it's 8 a.m. and you feel like trading because you have the time to trade. And now you think you could just come to the market and take money out whenever you want. And boy, is that not the case. And I'm pretty sure we can all agree on that. So what you do by, how to avoid that is by trying to look for much higher probability scenarios, because if you just look at the market long enough, it's a very dangerous place, okay? And having a high market IQ is even more dangerous because then you're going to be able to find something. You'll always be able to find something in this. You'll always be able to find the break of structure, the buy opportunity here. So now you think continuation, you want to buy again. You'll always be able to find something. And that's dangerous because that puts you in scenarios that you probably wouldn't put yourself in if you knew better. If you knew better, you do better. So just because you happen to be sitting in front of the computer, you can't just force a trade. You've got to wait for those prime scenarios to set up, the ones that you've back tested and been successful at before. Because if you just try to trade when you want to trade, it's never going to work like that for you because that's just not the way the market works. You understand? So a good way to eliminate getting yourself into scenarios like that where you're really not too confident in what's going on is do the 3 per week rule. Okay? Just write down on your desk right next to you, just put a little 3 times W, just like that, just like I have. Okay? What you're saying to yourself is if I was only allowed to take 3 trades per week, okay? If I was only allowed to take 3 trades per week, would this be one of them? Would this be one of them? Would you risk 1% on this? Okay, if that's what you trade, per week. But more importantly, if you were able to take 3 trades per week, would this be one of them? And then you're going to notice to yourself that you're going to stop taking such iffy trades, such kind of trades where you're really not that sure, but again it's 8 a.m. you're sitting down with your coffee, you feel like a trader. Now is your time to trade. You're going to avoid some stupid trades and some unnecessary losses if you start trying to refine your trades into only the highest probability, only the best probability. Those are the trades you want to stick yourself with, because if the goal is to be right, or if the goal is to make money, you're going to find out that you're going to make a lot more money if you start using this type of refining method. Would I take this if it was only allowed 3 a week? Would this be one of them? Your trade quality is going to improve dramatically, which means your wins are going to improve dramatically, and your exposure is going to go down dramatically because exposure is the enemy. And if it's not a trade that if you were only allowed to take 3 per week, and you don't think it's good enough, that means that you're not going to worry about exposing your money to that, which means that your losses will go down and your win rate will increase because you're only going to be looking at higher probability quality scenarios, and you're not going to be focused on being right. You're going to be focused on making money. Okay, that's a great one that I always think, and I always ask myself, if I could do 3 a week, if I could do 5 a month, would this be one of the trades I take? And when it falls into the category of yes, then absolutely go for it. Because at least then you feel a lot more confident in what you're doing, and if you lose, you're not really losing, you're learning from it rather than making the same mistakes over and over and over. So that's definitely something that I recommend you apply to your trading right away. And if you start taking a lot less trades, that's perfectly fine. That's good. That's what you would be doing if you had a boss over your shoulder that was watching what you're doing and saying, "What are you, crazy? You're not using my money for that bullshit. Hell no. Find a better trade." That's what we all need. But because we all trade independently on our own, we don't have anybody to look over our shoulder and attack us when we do something wrong like we would at a normal job. That's our job to do to ourselves. All right, and that brings me to my next point. When you're looking into trades, and you've got to treat it like a job, right? Okay, so let's say that you're trading this for a hedge fund. Everybody thinks that they trade for a hedge fund or for a prop firm when they're trading, FTMO and whatever the other trading, prop firms are that are right now. But again, let's just pretend that was real life, okay? And that you were actually trading their capital. You got to understand, guys, if this was $100 million, okay, $100 million hedge fund that you're trading for them, you can't just take a trade because you want to take a trade because it's 8 a.m. and you feel like price is probably going to go down from right here. That you can't. The problem is when you're using other people's money, okay, you've got to justify to them why you took the position, okay, which means that you've got to put a lot more effort and a lot more thought into trading, into taking a position, into exposing other people's money. And a lot of times it's funny because it's like we don't treat our own money with that type of respect, but we'll treat other people's money with that kind of respect. If you're taking your own prop firm, it's like whatever, I could pass this, no problem. But as soon as you try to take somebody else's prop firm for them or try to help them out for them or try to give them a signal or tell them a setup, don't you realize how much effort you put into that? Because now you have that fear of being wrong and having to answer to them. So do yourself that favor. Be your own boss, be your own manager, and be your own worker at the same time. If you're taking a stupid ass trade, somebody needs to slap you in the back of the head and say, "Hey, you're taking stupid ass trades. What are you doing with my money? What are you doing?" And we end up in these trades, guys, because we're trying to be right. We're not trying to make money. That's what we're doing. We're just trying to be right. We're just trying to get involved. And that's because there's no repercussion. You don't get in trouble. You don't get sent home for the day. You don't get fired. You just take a loss, and you know what? Nobody knows. You secretly take your little loss, and because you're trading by yourself on your computer, on your phone, nobody knows you just did a stupid ass trade that you know better, and you just eat the loss, and you continue to just run down that simple, unnecessary road all the way down deeper, 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 deeper into a hole till you give up and you're dead. That's what happens, guys. So you need to be much more hard and strict on yourselves, on your position. You've got to think, if this was $100 million account, if I had to explain this to investors, how would I justify this position? You're going to need to come up with an entire checklist of all the reasons why that this trade should go the way you think. Not based off of emotion, not based off of because it's 8 a.m. Monday and you feel like trading, not based off of because, somebody else posted this and it looks like it's going to play out. You need to be able to justify this through back-tested results, through scenarios that you've seen play out more often than not and in your favor more often than not. You need to justify, like our previous video, did the front line go in? Did they get killed? No, they survived. Okay, now that's fair. You should have a checklist like this, guys, when you're thinking about a trade. Okay, because this is what's going to help you get on the road to consistency and keep you from going deep into the hole and dying with everybody else. You've got to treat it like a business. You've got to put you've got to be penalized when you do stupid things because, they say make a million mistakes, just don't keep making the same mistakes. If you're able to take a trade and then you lose, and the first thing you say to yourself, and I've done this to myself, and I know you guys say this, is, "Damn, I knew I shouldn't have done that. Damn, I knew I should have waited. Shit, I knew that wasn't a good setup." It's easy when that's your only penalty. It's just you, slapping yourself on the hand saying, "Oh, I should have waited on the back." Yeah, but when it's real money, and it's other people's money, that doesn't work. That doesn't work. When you just lost, $500,000 in 2 minutes, and you say, well, honestly, guys, I knew I should have just waited longer, but I said, fuck it, let me give it a shot. That's that's the pattern that everybody's in because it's so easy to trade. It's so easy to push a button on your phone and you're in the market. Push a button on your computer, now you're in the market. If you had to fill out an entire contract, okay, and present this idea to somebody before you took a trade, you would take a lot less trades and you would take a lot more quality trades, okay, which means that your win ratio would go up, your exposure would go down, which means your losses would go down because exposure is the enemy. You understand? So again, you know, can you justify the position you're willing to take to investors? Can you? If you were only allowed to take 3 trades per week, would this be one of them? Start using these little cues. Leave them next to your desk, right next to your keyboard, and watch how your trades start to improve. Okay, I guarantee it. And if you just think about what I'm saying here, you see what I'm getting at. It doesn't matter the strategy; it's how you use it to make money that's important. Another thing that you guys should be thinking of when you're about to take a position, and it goes back to again, the same investor idea, because that's the goal, right? To trade for a hedge fund or to trade a large amount of capital for yourself, it needs to be treated, as an investment because you're investing money in and anticipating a return on that investment. So one of the main things that you should really think of is the same way. Think about a judge and an attorney. When an attorney or a lawyer, when they present a case to a judge, okay, whether it's for somebody who committed a murder or something like that, when they present this idea to the judge, okay, they have to have every single piece of this case completed. Every single question that the judge might ask, you need to have the answer to. Okay? And that's the same way when you're thinking about your position. Every single scenario that might happen, okay, and I always use this example, it's so easy. But every example or scenario that might happen, you need to have the judge, you need to have somebody here, which should ultimately be you, to sit here and ask all the questions that nobody wants to hear, all the reasons why this might go wrong. And then you need to decide on whether it makes sense to still get involved. Make yourself a column. These are the things that can go right. These are the things that can go wrong. These would be confluences that are in support of your idea. These are confluences that go against your idea. Okay, because you need to look at the trade in that way. You need to prove to yourself before you enter the market here beyond reasonable doubt, just like they say in the courthouse, beyond reasonable doubt that price should go this way. And then you've got to show yourself what those reasonable doubts are. Is there maybe liquidity over here that hasn't been collected? Okay, and maybe you don't want to see that because it's Monday morning and you're just trying to, you're looking at the chart like this. You're trying to erase that. You just want to look at this because it's Monday morning. It's 8 a.m. You're dying to get in the market. You don't even want to look left and see that liquidity that's there. So you're just going to try to get in, but you've got to mark that off in that column. You've got to say, all right, well, yeah, there is. That's one thing that could go against me. There's some equal highs left behind. Maybe price comes up and takes me out. It may not be the most attractive thing to do when you want to get in the market, but it's going to help you reduce exposure and it's going to help you pick out much more quality setups because you're going to avoid this whole thing when you see it. And instead, maybe wait for what? What did we say before? Wait for the front line, those guys to go in and take that risk, and maybe it takes those equal highs. Maybe it doesn't and it goes down, but at least then you can justify your position to your investors because you can say, hey, I saw this happen. It happened the way I thought it did, but now it's safe to get it. Now it makes sense. So when you're looking at it and you're trying to prove beyond reasonable doubt why you should get into a trade, set up a reason, or set up a column of pros towards your trade and also what might go against it. And don't try to hide the things that can go wrong. It's better to bring them out because eventually you're going to see a trade like this where you're going to have 10 boxes, 10 confluences that are pro for your trade and maybe only 2 against them. And then you go back to probability, okay? You go, okay, well, I got 10 to 2. That sounds like an 80% chance. That makes a lot of sense to me. I'm going to go for it. You see, guys, and this is what helps you lead to consistency. You see, and then when you win the trade, you feel good about it, you know everything that you did, and more importantly, you're able to duplicate it using the same process. And even more important than this, guys, when you have 10 to 2 and you lose a trade, listen, that's not a loss at that point. That is a very, very, very valuable lesson, because now you can learn to refine your strategy even better. Okay? Because now you're going to say, well, what did I do wrong? I only had a 20% chance of losing this one. What did I do wrong? And then you're going to come across something. You're going to say, oh shit, look at that. I never even thought about that. And you know what? That check that went against you will eventually become one on this side, because you're going to learn to use that and you're going to learn to avoid that. You see? But the only way you ever reach these type of results is when you take your time and go through everything that could happen right and wrong. So when something wrong does happen, you don't lose from it. You learn from it. Everybody says losses are lessons. Yeah, that's fine. But if you keep taking the same losses, you're not learning any lesson. You're just doing the same shit and expecting a different result. It's not going to work like that, guys. Again, not if the goal is to make money. Not if the goal is to be consistent. If you just want to be right, then you can keep doing what you're doing. But if you wanna make money, the main things you got to think about are reducing exposure, taking less trades, taking higher quality trades. Now higher quality doesn't always necessarily mean less trades. If you have quality trades, you might get 4, 5, 6, 10 trades in a week when the market's moving that way. If that dollar is trending nicely, you can get 10 trades that week. You know what I mean? And they're still considered quality trades. But if the market is shit that week, and you only get 1 or 2 trades, then that is just as important as getting 10 trades this week. Taking 1 or 2 or no trades is just as important the next week. The real thing is being able to differentiate the difference between being involved and not being involved. Which one makes more sense? At this point in your career, guys, if you're watching our stuff, I'd imagine you're a little bit higher level than a lot of people that are trading, that are still chasing Lamborghinis and ICT shit. But you got to really think about, how can I make money? What can I do to make this work for me? And that's what you need to do. And trust me, man, probability and higher scenario or higher probability trade scenarios are where it's at. This is where you want to be. You want to be able to avoid it. FOMO, like the fear of missing out and all that, leave that for the kids. Leave that for the rookie. There's no FOMO when it comes to real money, okay? Because you're not allowed to just want to get in the market because you have the fear of missing out. You can't explain that to investors. You can't explain that, well, sir, I was afraid that I was going to miss out. That's why I just lost 500. Now, you can't explain that shit. Absolutely not. You can't explain the fear of missing. There's no fear. Okay, that's not how this works. You got to wait till it's your time to strike and get involved. So forget about that. If you only see 2 trades this week and they work out for you, it doesn't matter the next guy that's taking screenshots of 50 trades. You have to run your own race because you've got to be able to justify it to yourself, because it's your money, it's your life at the end of the day. So just a couple more tips and tricks here on trying to differentiate, between being right and making money. Limit your trades. Try to give yourself at least the idea, if this was 3 trades, if I was allowed 3 trades this week, would this be one of them? Ask yourself that. If it is one of them, then great, get ready to execute. If you say, can I justify this trade to my investors? If this was $100 million account, can I justify this to my investors? And if you say, yes, it makes sense, boom, go for it, man. And can I prove this case? Can I prove this trade beyond reasonable doubt that it should go my way? Even when I compare the things that go for me and the things go against me, does it still lean in my favor? Yes, then boom, you have yourself a position. That's it, guys. And it doesn't matter. Let me tell you this too. It doesn't matter if you're trading a $10 account or a $100 account. If the goal is consistency, you need to trade it like it's a $100 million account, okay? Because that's the only way you're going to get a feel for what you're doing out there. It doesn't matter how much money it is. It's a game of percents. If you can make 10% on a $10 account, if you can make 10% on a $100 account consistently, then you can make 10% on a $100 million account. Okay, because it's a numbers game, guys. And don't let that confuse you. Treat that demo money, treat that $10 USD account like it's $100 million, like it's your own money, like it's your investors' money, and watch your trades start getting so much better that you won't even be able to believe it. Just by a simple little adjustments to your thought process. Hope you guys got some value. Talk to you.